Well, good morning, everybody, and welcome. I'm sorry to have got you out of your pajamas today. Actually, I'm not, but it's good to see you all, and we had a great morning yesterday as well in Cape Town. We had a really nice turnout, and it's actually, I must be honest, fantastic to see people. It makes it all a lot more worthwhile, and hopefully we have a good interactive morning, and we can give you a little bit of insight in terms of where we are at the moment in our life cycle. So maybe let's start with a bit of overview. So obviously we like to blow our own trumpet, and as part of that, we like to emphasize people that had faith from day one, have obviously been rewarded pretty handsomely for their patience and all. So that's maybe where we can start. Over and above that, the portfolio obviously has grown substantially since we started, when we listed with a billion rand portfolio. A lot of those early assets that were in that seed portfolio are part of the Statement 102 deal that we're doing with the black empowered entrepreneurs in Cape Town, and whilst they're still great properties, the reality is our life has moved on to maybe slightly bigger properties, and obviously we're looking in terms of our strategy of looking to attract fully A-grade and blue-chip covenant tenants, which, as a consequence of where the world is going in terms of supply chain, are necessitating significantly larger units, firstly, but secondly, the big buzzword in the last 18 months has been obviously ESG, and on the development side, obviously the sustainability is critical to what we are being asked for, but also what we are looking to deliver in terms of our short, medium, and long-term mandate to make sure that we remain cutting edge when it comes to these things. We I think have been extremely disciplined. I think over the years. I mean, from when we started, that there were some. There were I don't know what you want to call them, the halcyon days of the property industry, where there was so much money available and the market was going crazy, and money was being deployed nilly-willy all over the place. I think the one thing that I take a lot of pride in, and with the management, with my management team, that even when money was flowing big time, we never lost sight and lost focus of what we were trying to achieve and what we were trying to do. And I think that's actually very important. And I think that discipline has kept us well. Rian often refers to it as, we don't want to buy somebody else's problems. We don't want to create problems for ourselves in the future. And doing a deal for day one or year two income, we don't believe is a good deal for Equitas long term, in terms of creating shareholder value, and hence that discipline has been critical, we believe, to our success. Just in concluding, I mean, obviously what's been massive for us obviously has been the Newlands JV, and we'll talk a bit more about that as well. I mean, a lot of you probably sat on Segro's results the other day, and you can't not but be impressed. I mean, the numbers that they're churning out, and the way the market has really come to the sector, we're all great beneficiaries of. And we've started the process of year-end stuff, and the process of valuations and stuff, and some of the early feedback that we're getting from the valuers in the UK is astounding, even us. I mean, it's where the market is going there is remarkable. And why I say the JV with Newlands is a game changer is that I genuinely believe that if we hadn't entered a relationship like the Newlands one, I think our UK business would have come to a standstill, because with the cost of capital coming out of South Africa, I don't think we would have been able to participate in the quality end of the market that we are currently participating in, and by having the relationship, obviously, and we'll talk through it in a bit more detail, by having the relationship, the product that we are basically entitled to, and we are bringing onto balance sheet is giving us like a top end product, but obviously at a significant discount to value, which obviously is massively beneficial to Equites. So what is driving all of this? And obviously one of the critical elements is, and probably even more important, and especially in South Africa, it's certainly more important than online, is supply chain. The world has come from 20 or 30 years of just-in-time supply chain, shipping rates having been really relatively cheap, and processes having followed a status quo for many years. I think the advent of, I think, a little bit of political disruption between the US and the America relationship, and then coupled with that the oncoming COVID disruption, has resulted in a lot of these supply chains actually falling apart. And the consequence of that is, as you can see, I mean, try and rent a car from Avis, you can't get a car. And why can't you get a car? Because obviously they sold them down during the lockdown because they didn't need them, and now they're trying to buy cars and there's no cars to buy because the semiconductors haven't been produced, so they can't produce the cars. And that is just one example of many examples across an infinite amount of industries that has put the world in a position where if you're wanting to run an assembly plant, you need to have proper reserves in terms of the parts that go together. And I think that has become critical. And on top of that, though, what we're seeing as well is we're seeing the consolidation of the warehousing of these products. So the efficiency has gone out of the just-in-time, but the efficiency is coming in technology, artificial intelligence, and all the likes in terms of how you warehouse these products. And that is particularly so in South Africa, and we're seeing it, and we'll talk about it in a minute, across the size and the quantum of new DCs that are being built in South Africa in the last sort of 2 years, and what will be built in the next 2 years. The level of activity is at an all-time high. Obviously, over and above that, online, especially in the UK, has been massive. Online went obviously from about 19% pre-COVID. I think it hit peaks of about 36%, and it seems to be settling sort of maybe just below 30% of all retail sales, excluding fuel. So these are all positive markers. Obviously, in South Africa, we believe Gauteng remains the cornerstone of our business. In the UK, we don't operate in London. Some of the guys are going big in London. London, if you think the UK is expensive, London is even more expensive than that. So it's a different world. I mean, in terms of the UK, we're seeing 20-year income in the UK at the moment with a rent review clause linked to either RPI or CPI. In a good East Midlands location will guaranteed get 3.25 on the yield curve, but probably get 3. And if it is Amazon or a DHL, the reality is it could even go below 3. So the quantum of money just seems to be infinite at the moment, and it's coming from everywhere. So the demand drivers are second to none. Also, what's happened in the last 2-3 years is a lot of the competing REITs in the sector have acquired their own development teams. So a lot of the product that they're developing, they're keeping for themselves. So the quantum of product that's actually coming into the open market has been reduced dramatically from historic levels. And as a consequence, what you're seeing is a lot of developers are now getting into bed with, especially private equity firms, who are desperate to get into the sector but can't get in. And what they're doing is they're buying speculative builds, vacant occupation, and taking the risk on letting going forward. And the consequence of that is, the reason that's happening is that last year was, I think, 58 million square foot of new lettings in the UK. The year before was 51 million square foot. And just to give some context, historically, you know, a good year in the UK would have been somewhere between 30 and 35. So, you know, East Midlands vacancies, and Vaynant can probably back me up a bit later, but East Midlands vacancies at the moment, are sort of sitting below 1%, which is an all-time low. So the consequence of that is, you know, you're seeing a lot of the private equities coming into the market, and you're seeing a limited amount of land stock where prices have effectively doubled in the last 2 years, and in construction inflation, which is driving a process of increased cost of actual real estate, and everything effectively for it to be built. Rental growth, and you know, we've been talking the rental growth story in the UK because of the supply side constraints for quite a few years, and it's actually quite pleasing that we're being reaffirmed in terms of our view of the market from a few years ago in terms of what's happening today. In SA, as I said, apart from Takealot, I think no one else is making real estate decisions to cover online. Online is a function of a broader supply chain story. So Takealot are going. I mean, they're going big at the moment. So, I mean, they're in the process of building 50,000 square meters in Cape Town. They had started building that, but they had 35,000 already in Cape Town. Started building another 35. From the marketplace, we believe that they've given instruction to now build 50, and the reality is that before they've finished building it, they'll probably give the instruction just to build it all out and do all 70. Here in Joburg, they've done a deal where they've got a site for 80,000. They've started building 40, and the reality is that they'll probably give the instruction just to build all 80. In Durban, they've also opened their first significant DC. So they are obviously extremely active in the marketplace at the moment. Over and above that, though, all the retailers are active. As you know, Pick n Pay are building about 150,000 up on the East Rand here. I mean, DSV built 150,000 on the East Rand. They built 50,000 in Cape Town. They were going to build 50,000 in Durban. It would seem that decision has been put on hold as a consequence of last year's riots, and it will be interesting to see what they end up deciding to do. Over and above that, Massmart built 70,000 up at River Sands here in Joburg. They built 50,000 in Durban, and they've built 50,000 in Cape Town in the last 2 years. The Fashini Group have got a building of about 24,000 with us. They gave us the instruction last year to extend that, and that's going to be about 41,000 when it's finished. And we secured a deal with them last week where it was finally signed. We're building just north of 50,000 for them on the East Rand here in Cape Town. But on a site that's going to allow them to grow that to about 95,000 in total. We currently are negotiating with another significant retailer for a large unit also for the East Rand, which we're fairly confident will probably happen, you know. And then over and above that, you know, the likes of DHL, who do third-party logistics on behalf of, you know, the likes of Kellogg's, Procter & Gamble, Unilever, and all these global multinationals. We're seeing that the level of activity and the consolidation and the efficiency of supply chain is becoming more and more important. And the engagements that we're having at the moment are extremely interesting. As we stand at the moment, contracted in South Africa, Equitas is building at the moment about 155,000 square meters of space. I wouldn't be surprised if we don't contract at least another 100,000 this year, and maybe more. And it's not just us, it's across the sector. So the private guys, I mean, the Atterbury guys are extremely active at the moment. The Fortress guys are also extremely active. Improvon also active. So the sector itself is in really, really healthy shape. We've got absolutely zero vacancy in our portfolio. We had 3 speculative units that we'd built in our portfolio, which effectively, one was let just after practical completion, but the other 2 have been let before PC. They're both PC at the end of March, and both have already been let. So we currently have no vacancy in the portfolio, and as a consequence, we will probably release a little bit more spec into the market, but obviously always measured. We're not the biggest fans of spec, but we believe that with a very low vacancies in the South African market, generally for top tier space, that now may be a moment where a little bit of spec, sensible spec, may be worthwhile doing. And I think this is a consequence of probably for 2 years, very little new stuff was brought into the market in terms of speculative stuff, and people didn't make decisions for the last 2 years, and all of a sudden they've woken up. The world is coming back to life, and there's a realization that if you don't up your ante, you'll be the loser in the game. And then obviously sustainability is becoming a critical thing, and obviously we're very high up on the agenda on that. What's going on here? Okay, in terms of the portfolio update, obviously at the end of September last year, we completed the Amazon DC in Peterborough in the UK, and this is an example of why the Newlands relationship works, and it works so well for Equites. Is we were all in on this particular deal at about £37 million, and that's including paying Newlands their profit share, and we had the property externally valued at £53 million. The consequence of that is we were able to raise £24 million with a leading UK bank, which basically meant that our return on equity on this particular asset has gone through the roof. Over and above that, obviously what it's done, it's given us the flexibility to raise that extra bit of capital, which we can redeploy into deals. And this is an example of what we hope to see a lot more of in our growth in the UK. The Hermes Deal is another example. We will probably close out here at about 72 to 73 million pounds. Mush? You can. Usually we wait to the end, but I don't forget though. Okay, so this is about 72 million pounds, and it'll PC on the 18th of March, and our expectation is the valuation on this will come in somewhere between 100 and 110 million. The consequence of that is we'll probably be able to borrow close to 50 million on it, which means that we'll have a 100+ million rand asset with effectively 23 million pounds invested in it. So again, return on equity through the roof, and ability to redeploy. Adjacent to this, we've done a deal with a private equity company called Arrow, American guys. We're building 2 units, a combined total of about 450,000 square foot. And we basically doing this as a turnkey. They've given us a guaranteed price. We will sell them the land, we will build them the units, and then they'll pay us for them. If we manage to let them for them before PC, we do have what they call an overage, which basically means we get given a little bit of a bonus for having let it for them. But if we don't, we give them the keys, and all the risk on the 2 units is theirs, nothing to do with us. The consequence of that is that between Equites and Newlands, we'll make about £10.5 million profit, of which 60% is Equites's. So we will make about 6 million, just north of £6 million here, which is 120 million rand, which will go straight to our NAV line. So the beauty of the deal with Newlands is that the real premier blue chip stuff, our intention is to retain ownership of that and build our portfolio, so we maintain the highest quality in our portfolio. But what we don't want to do is turn down deals. So if there's a deal to be done with I don't know, Peter Pan Pty Limited as an example. The reality is that the UK market, the depth of investor is so deep that there is a buyer for everything, and if we can make a bit of money and turn it and put it into assets that we retain ownership, and if you think about it, we're making £6 million here. As I said, we've only probably going to have about 22-23 million pounds in the Hermes deal, and this is on the same site. If we put the £6 million back into Hermes, we're down at £17 million. So again, the return on equity story just goes one way. Basingstoke, we've submitted our outline consent plan. We should have a determination on this towards the back end of April. We'll keep you abreast. This is on the M3, basically driving out of London. If you're going down to Southampton, if ever you guys go to the UK and decide to go to Stonehenge, you will drive past this site. It's right on the junction of the highway. I mean, that's the M3 basically. That's a national highway going southwest out of London, and it's right on the junction. And as soon as we do have an outline consent here, this land in the southeast doesn't exist. So this land, effectively, as soon as we get that consent in place, will be spoken for very, very quickly. So just to give you a little bit of a quick update in terms of where we're at, up there is Hoylands. Up there is what we call Junction 24, which is right next to the East Midlands, that's Segro, a building next to East Midlands Airport. East Midlands Airport is a passenger airport, but it's predominantly a cargo airport. After Heathrow, it's the second biggest cargo airport in the United Kingdom. The one thing that East Midlands has that no one else has in the UK is you can take off and land 24 hours a day, 7 days a week there. So as a cargo airport, it's going to grow. The Segro East Midlands Gateway project, from what we understand, they have got no land left. They have let everything. 6 million square foot gone in what was meant to be a 10-year program. It went in 3. So we've got this site up there. We're in the process of putting in some detailed plans at the moment, and there's been a slight hiccup in terms of some changes in legislation around the 50-year stormwater levels and stuff. So we've had to tweak things and redo some stuff. But we very hopeful to be able to announce something there probably in the first half of this year. You come down a little bit further here, and that's Rugby, and we've got one site there where we've got outline consent, and we're about to submit detailed plans with a tenant. It's a 250,000 square foot unit which we will retain ownership of, right on the sort of the edge of the Golden Triangle. You can see there's the Golden Triangle, and we'll retain that. Then we've got three sites, 1, 2, and 3 over here, with the top one being Peterborough, the middle one Thrapston, and the bottom one being Newport Pagnell, which is Milton Keynes. All 3 of them have been submitted for outline consent. Peterborough is 2.5 million square foot of bulk. Thrapston is 2.1 million square meters of bulk, and Milton Keynes is about 880 square foot of bulk. We should have determination on all 3 of those. Certainly the first 2 in the first half of the year. Peterborough may be Q3 of the year. The Thrapston outline consent has been supported by DHL. So DHL have lent their name to the application, and they are requiring units in this particular park, and as a consequence they've allowed their name to be used, and obviously they will benefit in terms of the developments that we'll do there, because they'll come in as a joint venture partner when we potentially do deals there. But the benefit of having a DHL stand behind your application is that they've given details in terms of how many jobs they're going to create and with the application, and obviously that's massively beneficial to an application. What's also important about Thrapston is that the North County Council have basically agreed to a 16-week participation agreement, which means they have to determine in 16 weeks from a statutory point of view, which you don't always get. In fact, you rarely get it, but they've agreed to do it because they want to see this site basically unlocked. They want jobs. So we're really enthusiastic about that, and the other one down there is Basingstoke, as you can see it. The red ones are more medium to long-term deals. I mean, the one on the right is at Cambridge, one on the left is at Nottingham, sorry, not Nottingham, Northampton, and then this is Egham, just south of Heathrow, and then, but those will probably be more 3 to 4 year programs where we keep feeding the machine. And these are 11 sites that we currently control with optionality and ownership. So, okay. Okay, I mean, again, this is the TFG deal that I sort of spoke about. We're going to be starting this bulk earthworks. Should probably start in the next 4 to 6 weeks. And then this needs to be PC'd basically by next year, April. They've got to fit out. Basically, they've got a go live date here 1 September next year. They need to be fully live 1 September to go into Christmas. Now, TFG is a classic example. They bought Jet extremely well. Jet has added probably about, I stand to be corrected, but I think it added about 20% to their revenue. But what it's done though, it's doubled their units of movement. And the consequence of that is that they've had to really think their supply chain again to ensure that they can meet the demands of working in that retail space where they need to get units to store as quickly as possible. And especially in the lower LSM market, you know, the marginality is probably a lot tighter. So if you get it wrong, the potential for not making money becomes that much higher. So we're very excited to be working with them, and it's a long-standing relationship. The teams, our team and their team really work well together, and obviously very excited about this deal. This is the extension. As you can see over here, that's Premier. This is the Hisense TV guys they store in there. This has just been let. We are about to do Premier Phase 2 over here, so that's been signed. And then this is TFG. This is the extension, which is basically coming up to here. You can see that. This is Cargo Compass at Jet Park. This is the Avenge head offices that we bought, knocked everything down, and we've created an 18-hectare park in Jet Park. There's no secure estate park in Jet Parks. The level of demand that we're seeing at this park is off the charts. Very excited about this park as well. And then just in conclusion, I mean, I think the critical one here is you know, 1.5 billion in terms of cash flows required to feed the machine that is currently contracted. What's not in there is what's not contracted and what we think has got a high likelihood of success. And we are extremely positive and extremely excited with where we're at. And as you can see, the list here will continue to grow. And you know, we are extremely well positioned to take advantage of the market at the moment, both with, and Leila will talk to it just now, in terms of our cost of debt, and then obviously our cost of equity has regained some of its pre-COVID luster, and as a consequence, you know, I think as an organization, I don't think we've ever been in a better position. The loan to value, as you can see with last week's capital raise, once we've contracted everything, still very conservative. I think what's important about the loan to value, and the reason sometimes it's there, is that, you know, the reality is that we rarely deal in 50 or 60 million rand deals. When we do deals, they tend to be 500 or 600 million rand. The consequence of that is that flexibility of balance sheet is required to ensure that when we transact in those kind of volumes, that, you know, we don't put ourselves in a you know, a loan to value sort of neck brace, should we say. The other thing, obviously, guidance. We reconfirming guidance in terms of where we're at, and yeah, everything seems to be on track for the year. You know, in concluding, before I hand over to the team and let them extrapolate on some of the more detailed stuff, what I would like to say is that we've come through 2 years of COVID, and looking with the benefit of hindsight backwards, you know, as I said, we've never been in better shape. But what I can tell you is that through the process, there were many months where, you know, as much as we were hoping that things were going to be fine, we didn't know. And I think the point I'm trying to make here is that the team and the work that the team did under extremely difficult conditions, with all that uncertainty through the process, has been off the charts. I mean, you know, Rian and Layla as my co-execs, in terms of Layla making sure we had money, Rian making sure that our clients were always fully aware that we were there to support them. With the communication levels that we had with them just went to the next level, and then obviously the senior managers below them as well, in the work that they've undertaken in the last 2 years under very difficult conditions has been just off the charts. I mean, I can look back over the last 2 years and just say, wow, did that really happen? And I really want to re-emphasize the quality of the team that we've created at Equitas, with 39 members of staff, the level of passion in the team, the level of desire to come to work. I mean, the three of us, I think, have been in work since, I think we went back to the office in May 2020. You know, we never stayed home. I mean, you know, two problems is we had to talk to each other, keep each other company, but most importantly, we had to stay away from the fridge. So yeah, the beauty of that is that the team, I think, has got closer through this period. The platform has never been better, and we're very excited about the future. I want to hand over to Rian now, for him to give you maybe a little bit more of an update on where we are operationally and what we're doing that is going to differentiate us.
Hello. Thank you, Andrea. Just, I think starting with the UK, fortunately the quality of our tenants in the UK and how business has evolved on that side, even through COVID, we've never had any difficulties with any collections. As you are aware, in South Africa, initially we did give some cash flow relief to a number of tenants. We are back to normal levels of payments, and our collections have been outstanding over the period of COVID and subsequently. I think operationally we also always inquire from our tenants as to how their business are doing. Given the high percentage of A-grade tenants, we're very pleased that by and large most of them are back to pre-COVID levels, and we are confident that going forward the robustness of our portfolio in South Africa will serve us well. The most interesting aspect for us in terms of our business is what's happening in South Africa at the moment. As Andrea has continuously communicated, under the COVID period, there was a reluctance from tenants to sign up new deals. There was so much uncertainty, and that pent-up demand is really coming through at the moment. And Leila and I have just done a quick calculation on transactions that we're currently working on is close to 3 billion rand in South Africa. Now, it's not to say everyone will work, but I'd be very surprised if we don't announce a significant number of transactions over the next 12 months, which obviously bodes well. And I had a quick discussion with Fayaz outside, and a year ago there was a lot of concern that maybe with the acquisition of an additional 60 hectares next to the OR Tambo airport, we may have been overexposed to land. Interestingly, and we're very pleased that if the current negotiation with the premier retailer leads to the conclusion of a contract, which we think in principle has already been agreed, we would have finished the 60 hectares there. So it just shows that our decision to buy and commit to larger parcels of land have really stood us in good stead. And when you look at the Riverfields area and our facilities that we've already put up there and those coming, it's going to be an absolute unbelievable logistic location. So we're very, very pleased about that. And yeah, so on the UK side, things are progressing very well. And Andrea did give you some insight on that, and we're also expecting to announce some very interesting transactions over the next 12 months. That's sort of from my side, and I'm happy to take some questions afterwards.
Thank you, Ray. So following on from my two colleagues, I think my role is really to look after the balance sheet and also to make sure that we're generating the returns that our shareholders expect of us. So maybe just to start, I think at the beginning of the pandemic, we stressed the importance of a conservative balance sheet, and we really wouldn't have been able to come through the period as unscathed if we didn't have that. So in that vein, we've maintained our fairly low LTV, but Rian alluded to something important. He said that there are approximately 3 billion rands worth of transactions, which isn't included in our pipeline slide. At the moment, after raising capital last week, we did a little bridge, or it's in the presentation, but we did a bridge to show where we think we'll end up in terms of LTV. And thank you. So if you look at where we'll end up, or where we estimate we'll end up, the LTV ends up being 30.1%. So the impact of the book build was a 4.3% decrease in the LTV. And then second to that, the fair value uplift in the UK is a very powerful contributor to NAV growth as well, which then feeds into reducing the LTV. So at 30.1%, interestingly, if access to capital markets were completely to dry up, if we couldn't access our joint venture partners, if all our alternative sources of equity were to dry up, we could still implement approximately 3.5 to 4.5 million rands worth of developments without tapping equity markets, and that would take us to 40%, which, while it's on the upper end of where we'd be comfortable, it's still manageable. In addition to that, we've started tapping other sources of equity. So as Andrea alluded to, the transaction with Arrow, where we'll be disposing these or doing turnkey developments, and other transactions in which we can dispose of land, we're estimating that that could add up to 1 billion rands worth of pure reserves, which will go straight to the NAV. So really what we're trying to do is to build a balance sheet as robust as possible. I think if there's one thing that the pandemic has taught us, it's taught us lots of things, but if there's one thing that it's taught us specifically, it's to keep looking forward to opportunities, but at the same time make sure that you're protected enough to be able to manage any difficulties should they arise. So, I mean, just from a LTV and a NAV perspective, that was important for us to discuss, and it's always been a focus of ours. I think on the other side, while we're looking at implementing all these developments, it's really important for us to manage our cost of capital. Now, on the equity side, we raised last week, and it was at a fairly healthy premium to net asset value, at a 17% premium to NAV, and that helps us from a cost of equity perspective. But where we've spent a lot of time is really working on the perception of equities in the debt capital markets. And I want to pause here for a moment and just spend some time talking about how investors have responded to our placements in the debt capital markets. In 2021, and this is a stat which I quite like, our corporates, or our debt sponsors, Nedbank, alerted us to the fact that besides Mercedes and Toyota, in the corporate debt space, or in the corporate issuance space, Equitas was the most tightly priced issuer in 2021. Now, that's for a REIT, and that's for a company which was operating in a sector which wasn't very well loved over that period. So what it does show is that we have those strong property fundamentals. We have a business which investors are recognizing is a fairly safe place to invest their funds. In addition to that, and this just happened this week, Nedbank have a facility, which it's a 5-year facility with us, but they roll a 12-month note in the background. And generally, there's a delta of about 10 basis points between a listed and unlisted note. Nedbank chatted to us and said, look, there's probably going to be a delta. We said, can you push a little bit, see if investors are willing to forego that delta? And they actually came in a 12-month paper at JIBAR plus 120, which is the same level we're raising at in the listed space. So again, the demand for our listed paper is really phenomenal. And what we want to try and do is just to maintain that relationship, because again, the importance of diversity, it's one of the things which we've really focused very hard on doing, diversifying the sources of funding and the counterparties who are the funders. So that's sort of it from a balance sheet management perspective. Just from an income statement perspective, I wanted to reaffirm our guidance. So we're still reaffirming our guidance of between 5 and 6%, but a very important area that we're focusing on is double-digit total returns. Andrea spoke about the Peterborough Amazon asset and how that fair value compression will be delivered straight to the NAV. We have the Hermes Hoyland's plot. There, it won't be complete at 28 Feb, but we will take a portion of the fair value because our policy is to recognize fair value uplifts on percentage of completion method. So we've seen values compressing significantly again for the 6 months in the UK. In South Africa, we've just started getting in our valuations, and what's really pleasing is that for the first time, valuers are starting to report fairly consistent values, consistent to slightly upwards. And I think this is just as a result of, firstly, the asset class proving its outperformance. Secondly, the quality of product. There is still a differentiation between the true A-grade product and slightly inferior product, and we're seeing that coming through in our valuation. So from a value perspective, both in South Africa and the UK, we're quite pleased with where these valuations are coming in. So I think that's it from a financial perspective. Andrea, Rihanna, am I missing anything? Okay. I'm going to move on to sustainability just very quickly. But sustainability has been something which we've been punting for a couple of years because we know from a moral perspective it's something which we have to, as landlords, we have to be responsible corporate citizens. But when you start breaking it down into E, S, and G, there's actually so much to do. So what we've done, and we've just appointed a resource which is solely responsible for maintaining or coordinating all of the sustainability efforts across our group. So in terms of developments, I'm sure you've heard this before, but all new developments that we build are built to be EDGE certified, and in the UK to be BREEAM, at least BREEAM very good. So EDGE is basically saying that your building is 20% more efficient in terms of water, electricity, and embedded materials than the average build. What we're actually doing now is that a lot of our buildings are going to advanced EDGE, which means it's 40% more efficient. Now, it feeds in nicely to finance because we can raise green loans on the back of that. But what it also does is it ensures sustainability of the tenant and of the building. We've always said we're not building for the short term, we're building for the long term, and that's what our buildings are trying to do now. What we've also done, bless you, what we've also done is on all of our existing products, we've completed sustainability audits, and we've gotten costings and ROIs on upgrading those buildings to getting them into the 21st century. What would it cost to, it's in the 21st century already, but what would it cost to get them to be truly sustainable or EDGE certified? And on some of them, they're quick wins, changing some of the lighting, changing some of the water features, putting in a PV system which isn't necessarily massive, and the payback period can be something like 3 years. On other projects or on other buildings which are slightly older, that payback period may not be feasible for us to conduct. And that'll be the next part of the journey. It'll be identifying what those older assets are and seeing if they become non-core and how we deal with those. And that's a living, breathing process which we are undergoing at this moment in time. From a social perspective, we have actively involved all communities in which we're developing. So we have community forum engagements on all of our projects, and they basically aim to get the local communities involved, to get them working on our sites as far as possible. And then a couple of weeks ago, Rian also met with the Alexandria business community, where we're trying to find how we can collaborate with them to ensure that they are incorporated in any upliftment we do in any precincts. So it's very much in thinking about how we can involve the communities and provide broader benefits to the surrounding communities. And then from a governance perspective, as you all know, we engage with our shareholders on an annual basis to understand their views with regards to governance and remuneration and other policies. So in line with our findings, every year we aim to improve governance in some way, shape or form. Again, it's something that's living and breathing. And for this year, we've just again refreshed our terms of reference to make sure that our board are covering all elements which they should. We had 2 directors which had served a sufficient period of time and were rotated off the board. And again, we just aim to keep up in line with the best practices as promoted by King, Sustainalytics, and any other governance boards' best practices. So I think from my perspective, that's it, touching on finance and sustainability, but I'll be around and we're happy to take any questions now.
Thank you, Leila. Wynand is just going to, a couple of highlights that he's probably closer to in terms of it, and then we'll start the Q&A thereafter straight away.
Yeah, cool. Hi, guys. So maybe just 2 topics from our side. The one is we get obviously quite a lot of questions around the total return outlook that we've provided to investors. I think it's obviously, as you guys can see, the uplift is quite strong to the balance sheet. But we just thought, instead of just guiding on DPS, we want to start putting out a total return. That's calculated essentially as the DPS over NAV plus the growth in NAV. It's a very similar methodology to measuring the total return of a direct property, or if we were a private company. So I think it just aligns it very well. I think we're all proud to say we're not DPS junkies. I think, to give an example, if we had to sell Hermes at a 3% yield, reinvest that into a 5% yielding asset, we're going to get 2% yield pickup on a 2 billion asset, maybe adds 40 million to the income state, 4% growth to DPS. We could do that, but I think that's not what we're trying to do here. Still trying to build a high-quality portfolio. So, yeah, and then just the second point that I just wanted to flag is we've started putting out some thought leadership pieces. The first one is on sale and leasebacks. And, yeah, we've published it on LinkedIn. It's on our website. We're just trying to, inspire the retailers to rethink their strategies around ownership. And, yeah, it's been good. We actually got a meeting with a national retailer, which is not currently a tenant, still very early days, but it just, sparked some interest and some debate. And, yeah, that's all from my side. Thanks, guys.
Do you have any questions now? Maybe you want to go.
Yeah. Cool. Is there any questions? Here we go.
It's Professor Jan Kruger. I have two questions. The one is flexibility of your buildings. Should something go wrong with retailers due to whatever, how flexible are your business, your properties for other, other uses? And the second one, I know it's very short notice, but the effect of Russia on Ukraine.
Okay.
How do you expect that to affect you, and how? Thank you.
Okay. So in terms of flexibility of the product, I think because we are building best-in-class product, height, flat floors, big yards, numerous doors, the reality is that a lot of the specialization will be in the artificial intelligence and the technology that gets put inside the warehouse. So the ability to have a second generation tenant come into one of our buildings and be able to operate, I think has never been better. I think, unless there's some massive technological upgrade in the next few years, I don't foresee that changing. So I think also the technology in South Africa will always be a little bit muted, also because government puts a lot of pressure on the guys not to spend too much on technology, because obviously we do need jobs in the country. So in Europe you're seeing a lot more sort of going away from let's say the human side of it. In SA we're certainly not seeing that. So we're very comfortable that our products have got a minimum of 20 if not 30 years on them. So
maybe if I just might add, one of our investment criteria, also when we make a decision in developing something for a tenant, is we always assume that what would happen if the tenant goes bust or something unforeseen happens. So unless we are comfortable that, and that was a big discussion point in our acquisition of the DSV campus, which transferred to us the second week of January. And we put a lot of emphasis into studying what would happen if after 16, 20 years DSV were to move out, because it's multiple buildings, and with our architect and industrial engineers, we devised a plan which made a lot of sense for us. Should you have 2 or 3 different users for that enormous space, and also how you could create different entrance points. Because in today's world, you've got to assume that a business may cease to exist, it may be overtaken by events. So we may not be there at that stage, but it's a very, very big part of our investment criteria and decision-making processes to think of that very element.
thank you, Rian. In terms of Ukraine, wow. Again, this is a personal opinion. I mean, I don't think, and everybody, I'm sure, even my colleagues here may have slightly different ones. I mean, the first thing that springs to mind is, you know, oil at over $100 a barrel, probably going to hit 110 in the not too distant future. You know, we were with one of the major retailers last week, and one of the topics of conversation was that a container coming out of China 3 years ago that cost about $2,000. 6 months ago it was $15,000, and they were talking that basically with the turn of the new year that had come down to about $13,000. So still significantly higher than where it was, but with the events of what's going on, probably going to go back to 15 and maybe more. So what does that mean? It probably translates into significantly more supply chain disruption, which means that we need bigger warehouses to store bigger and bigger goods. And yeah, I think the world where we are at the moment is going to require significantly more warehousing that is currently out there. And like all these things, it will get to a point where maybe too much is built, and we will have a leveling off at some point. But I do think that where we are in our cycle and what we're doing is that because we develop a lot of these things internally, I don't think we won't ever overcapitalize into a product. We'll always have that buffer of margin, which will give us a degree of safety. And then coupled with that, I think we're quite a conservative bunch as well. I mean, if we had been a bit more gung-ho in the last 5 years, I think the world would be very different for Equites today. I hope that answers the question. Moish, maybe we'll hit you with a question there.
Sure, thanks. So I've got 3 questions, right? But we'll just go one at a time. So the 35% capital appreciation that you're expecting on your Amazon property, right? I just want to get a sense of where that sort of fits in your spectrum or range of uplifts for future projects as well. Now to have a bit more information.
Okay. So, like all things, I mean, as I said, you know, construction inflation last year in the UK was 20%. The anticipated inflation for this year is another 20%. Availability of quality builders to come and build for you is becoming tighter and tighter. Fortunately, through our Newlands relationship, you know, we are very close to Winvic. We're very close to another company called also Reedy, and we would like to maintain relationships with 2 or 3 other good quality warehouse builders, if you like. But those are on the supply side some of the issues. The consequence of that is demand keeps going, yields keep compressing. They can't compress forever. I mean, I don't think we're going to get to 0% yields or 0.1% yields. But in that compression, obviously, the value proposition in terms of some of the tracts of land that we have will have material benefits for the landowners, because you know we don't own all those tracts of land. We have options on them, and as pricing moves, the value that they'll get out. But obviously the benefit for us is that we don't have to put any significant money on the table to have control of all these tracts of land. So we'll still control the deal. We're of the opinion that ultimately Equites will always have about 150 basis points, somewhere around there. Some deals slightly more, some deals maybe slightly less, but let's take as an average about 150 basis points of value between value and actual cost. And obviously that 150 basis points gives us the disproportionate return on equity. And it also gives us that safety margin that I think I spoke about there, that even if the market were to get to a point where it comes off a bit and it stops being as hot as it is, I think we would still be in the money. I don't think we're going back to, you know, prime logistics warehouses at 6 and 6.5% yields. I mean, I don't think that will happen again. I think that those days are gone.
Okay, thanks. And then maybe this is a bit more directed at Leila, but the UK uplift on Amazon, I'm assuming is included in that LTV calculation, but then have you factored in Hermes yet there, or no, not at all?
Yeah, so Amazon is included, yeah, but Hermes, because it's still in completion or under construction, because Hermes is still under construction, we were a little bit more conservative in how we assumed the fair value of Hermes. Are we too close? Wish.
Okay, cool.
So some of it is in there, but very conservative in our assumption of what fair value would be. Agreed. Yeah.
And then lastly, just on the site where you're still planning to submit, I have to figure out what are the sort of main risks that are attached to getting those over the line.
The UK planning consent process, it makes a hell of a lot of sense all the way up to committee day. And committee day is then decided upon by politicians. So the risk is that you're dealing with unknowns on the day, and emotions sometimes can run large. The benefit of the process, though, leading up to it is that the submissions are extremely detailed. You need sign-off from ecology, from heritage, from roads, from stormwater, from the whole lot. So, an application when it goes in is a book, and all the applications that we've submitted are going in with a recommendation for approval, but that still doesn't guarantee anything. The benefit of a recommendation for approval, though, is that if it does get rejected for whatever political reason on the day, because it is an on-the-day thing, is that you can go through a process of appeal, which then removes the decision from the politicians, and it actually goes to an adjudicator that is a technocrat. But obviously it takes time. And your biggest risk to a lot of these things, I think the skill that Newlands have is that their ability to identify land that will pass muster in terms of approval is what they've been very good at for many, many years. Now, what that means is that on a journey, you might get some rejections, but the reality is that their ability to then re-engineer the application and resubmit and eventually get there is one that we have utmost confidence in. So we are confident that every single one of those schemes that you see on there will at some stage get its approval. What we can't tell you, though, is that will it be on first submission, second submission, or fifth submission? And ultimately, sometimes it makes sense to re-engage with the politicians to get an approval rather than go through an appeal process. An appeal process does create, what's the right word?
Tension.
Tension with those committees. And if ever you're wanting to do business in that area again, the reality is it potentially, I'm not saying it will, but potentially could be held against you. So you've got to be mindful of these things. So it is a process. I do think in Newlands, though, we've got a skilled team that have been doing this for many, many, many years.
Thanks.
Any other questions? Yes.
Hi, Sindiso from Visio Fund Management. Good to meet you all in person. Just a couple of questions on the SA market and your portfolio here. Could you give us a bit of color on where the rents for your spaces are relative to the rest of the market? Would you say they're at a premium, and if so, how much? Really just trying to gauge if we could see pressure on rents, for example, on renewal and reversion.
Okay. Maybe Rian will give it more color now, but what I can tell you is that as a function of really very, very low availability at the top end of the market, in the market at the moment, I mean, we are in the process of putting in a couple of spec builds into the pipeline, and we're marketing them, to put context, at 80 Rand a square meter. So the reality of it is that we've seen some construction inflation in South Africa for the first time last year. I mean, that was also a consequence of steel prices having gone up about 40%. Steel makes up, in a total construction cost, probably about 30% of a build. So I think we saw we saw sort of between 8 and 10% inflation on our construction projects last year, and I'm not saying we'll see that again this year, but we certainly see at least sort of 4 or 5%, I'm sure. The consequence of that is that, you know, land prices aren't getting any cheaper. The ability to get land through the process with some of the municipalities becoming harder and harder, and the availability of large tracts. It's all fine and well if you're building a 3,000 or 4,000 square meter warehouse. There's lots of land that you can build that on. But if you're wanting to build a 50,000 square meter warehouse, you need a minimum of a 10 hectare site, potentially even 12 hectare. And to have a 12 hectare site in a rectangle, you know, with all the availability of sewerage, electricity, water, and then a degree of platform, if you like, or not that you're on a hill like this where the bulk earthworks are going to be prohibitive. The reality is that I think you'll struggle to make anything work much below 80 Rand a square meter. So we are foreseeing, and we are going to be promoting significant sort of rental increases that we haven't seen maybe for the last 3 or 4 years. So yeah, the pricing tension is coming into the market because, like all these things, you know, availability. You know, one of the spec builds that we put out at the end, we had 3 users basically vying for the one space, and you know, and we were able to actually get slightly more than our asking rental on that particular piece of space, which is, you know, the first time that's happened probably in about 3-4 years.
And maybe just to follow on the experience on your existing portfolio and your current tenants, what is the experience on expiring leases? Are you able to achieve on renewal the same level as the exit rents, or are we seeing there?
So I mean, that's the perennial question we get all the time is obviously the reversion question, and you know, ultimately it's very deal specific, and we have a portfolio that we acquired off Attack at the Waterfall Estate, that were buildings that were built between sort of 2014 and 2016. And so we've got quite a few expiries. They were all 10-year leases, and a lot of them had 8% escalations on them. So we foresee that portfolio, when it comes full circle between 2024 and 2026, that there will be some reversions in that. Obviously, we don't know what will happen between now and 2024. A little bit of inflation is definitely creeping into the local market. Obviously, globally, inflation is becoming a big issue. But there's no question that there will be some reversion. The reality is, though, is that with the amount of new stock that is coming into our portfolio and the size of the portfolio as it's growing, the impact of those reversions, when they do come through, we believe will be slightly muted. They'll be there, but they will be muted, because we'll have a new 50,000 square meter deal with TFG that will basically be coming through the cycle, and it will dwarf the 10 or 15,000 square meter facility at the Waterfall Estate. But there's no question that there will be a degree of reversion after a 10-year lease where you've had 7.5%, 8% escalations for 10 years. So how big will that reversion be? Yeah, I'm not sure. I mean, what we've seen in recent times is that, you know, I don't think we've had a reversion of bigger than 10%, and we've actually been quite successful in actually often coming out fairly flat. There's certainly been no growth on renewal. That's for sure. I mean, the last 2-3 years in particular has seen absolutely no growth in rental. So as a consequence, if you've been escalating through that period, you will have. But obviously, because of the size of the portfolio, I mean, the portfolio, all things being equal, I think will probably, you know, at year end, I'm not 100% sure, but it will be probably the South African portfolio will probably be about 15 billion, you know, and so if you have 150 or 200 million rand property that's reverting, its impact on the greater portfolio is muted.
That's it for me, thanks.
Sorry, just just one question. Okay, we're going to Fayaz first. Okay. So, yeah. 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 And yeah. And we're trying to manage that process, you know. Also, I mean, Rian has done a lot of work with tenants where what we've done is we've tried to go to them early. So we haven't let leases expire. We go to them maybe with 3 years left on the lease, and we'll say to them, listen, you know, what can we do for you to renew, and what can we, from a capital nature, what can we add to the building? And, you know, often it's putting in LED lights and, you know, potentially putting PV panels on the roof. And it's looking to bring the sustainability element. And what we find with some of the global players is they've actually got budget to put in as well. So they might match us rand for rand. But every negotiation isn't equal. But I think ultimately, if you look at our numbers and the fact that we can still give the guidance and we're pretty comfortable with the guidance, I think within that there's enough growth to mute the effect of the reversion, if you like.
Hi. I just wanted to ask, on new builds in South Africa, what's the break-even rent per square meter that you need to achieve?
Okay, again, it depends on what you're building. So, as you may be or may not be aware, in our year-end presentations, we often we have a slide where we talk to the 3 types of product that we have. Well, we've got 4 types of product. The first one is just a straight single-face warehouse with a yard in front, with sort of an office component, which is 5%. Now, something like that will range in rent, basically probably between 65 and 75 rand a square, depending on location, depending on a few other metrics. Then you have what we call a cross-dock facility, where you've got a yard on both sides, and again, not a great component of offices, a small component of offices, but because you've got the double yard, it's a land-hungry development, and one of those will probably go somewhere between, I don't know, 85 and 95 rand a square. And then you've got the ones where, like we've got at Meadowview in the Longmeadow area there, where you've got a big component of offices where some of the guys basically bring their head office and put it on the warehouse. And obviously, as you can imagine, an office costs a lot more to build than a warehouse. And the consequence of that is you're probably doing a deal at approximately between 65 and 75, or 65 and 70 on the warehouse, but the office is probably going in at about 130 to 140 rand a square. And as a consequence, your blend is probably coming in somewhere between 85 and 90 once you've done it. So it's very dependent on what you're building. And then obviously the fourth element that we have in our portfolio is the specific stuff. So that would be the hangar in Cape Town. That would be the bakery that we've got in Cape Town. You know, that would be the DSV Pharma building, which is a dark warehouse with a lot of technology in it. And those things obviously stand completely outside of the realms of normal warehousing.
I mean, as you scale your portfolio, how much land would you be comfortable to sit on, given that you know the cost of carrying that land?
Yeah, I mean, you know, I think at year end last year, I stand to be corrected, but I think we had about 110 hectares of land in South Africa. I think we'll probably go into year end this year with 25 hectares. Now, the reality is that is deal flow, and if we didn't have that land, we couldn't do those deals. So where we're also wanting to operate and trade is in the bigger units. So consequently, you know, when you buy a tract of land, there's no point buying 5 hectares. 5 hectares isn't going to solve many problems. Over and above that, what we're seeing also as a consequence of what happened in KZN and Gauteng last year with the riots, is that there's a real big move to security. And what we're seeing, you know, is that people will pay a premium and people want to be in secure estates. They see the estate as a first line of defense. Doesn't take away from the defenses that they're creating for themselves, and we're seeing that particularly with the global players, the international companies, in terms of their staff well-being processes. I mean, the amount of money that they're spending on security and what they're prepared to spend on security to be in these estates. So the consequence of that, to get the economy of scale for an estate, it starts becoming, even at 18 to 20 hectares, in terms of having a central guardhouse, having a gate, perimeter and everything, whilst you've got certain mitigating circumstances, because you can have central pumps and tanks, you can have a central PV system to give electricity to the warehouses and those things, but you've got a full guarding function for 20 hectares of land. So, if you can get a park which is sort of 40 or 50 hectares, the economy of scale of the security for the park obviously does come down. So our opinion is that for us to carry on playing where we want to play, having 100 hectares of land on our balance sheet in South Africa doesn't frighten us. We believe it's a number that we can certainly fight nicely with, and what it does is it gives us flexibility to be able to do deals. The reality is that we've got two massive deals that are happening in Cape Town at the moment. 70,000 for Takealot, 40,000 with Truworths, and we're nowhere near them. And why are we nowhere near them? Because we don't have land. We couldn't, we couldn't compete. We couldn't participate in those processes. So if you want to do those kind of deals, the reality is you have to hold the land. I hope that answers the question.
Just a question on the UK. Obviously those supply-demand imbalances have been around for a long, long time now. Do you see any change, especially given the fact that you've dipped your toe now into last mile? Do you see any change in the nature of demand for particular product types? So obviously the initial demand would have satisfied, some of the big box over 100,000 square meters. Is there a change, is there a pivot, and is there a way that you can adapt to that pivoting demand?
Yeah, so I think the big box remains and it is like a cornerstone, if you like. It's a foundation of the industry. So everything has to arrive and it has to be stored somewhere. We see the demand drivers there because of, supply chain optimization, because of onshoring, because of just in time being something of the past for the time being anyway. So we still see that as a cornerstone. The last mile obviously becomes critical. I mean, I'm not sure how many of you were SA REIT, but Bart Haysons, I think his surname is, from Morgan Stanley in London. I mean, he put up a chart, I think, which really expressed it critically, and that if you look at the cost of the last mile function, 50% of it is actually in the distribution leg, and rent only makes up about 4% of that total cost. So the consequence of that is, and what you're seeing is, especially the guys going into London, and who's really at the forefront of that is Segra and Prologis, Goodman's to a certain extent, but the numbers that these guys are paying, because the reality of it is they know that even if they charge 20 or 25 pound a square foot for that facility, it still pales into insignificant in terms of having to deliver it from 50 miles further away in terms of the cost of that last mile function. So the last mile function is also something that never existed before. So you're building new stock from the get-go, and everybody has to be there. So I see the last mile function. I mean we've been privy to some of the big online guys, and the numbers that they're putting down in terms of the quantum of units that they need to put up in the next 10 years, it's eye-watering. It's numbers that just, without disclosing too much, obviously, it's. I don't see that last mile function slowing down anytime soon, because it's not like you can just go into an existing box or something that can be recycled. There's so much in terms of how it works and operates that you actually have to start from scratch. So the last mile function has got massive legs. The big box at some stage may have a little bit less legs, but what we're seeing is, in the big box as well, is the guy that used to, or when I say guy, I say that generically, I mean that needed 200 or 300,000 square foot. That business now needs 500,000 square foot. So, you know, you see the likes of Panattoni in the UK. I mean, in the last, let's take the last 2 years out. In the previous 18 years, I think there were only 2 speculative boxes that were built above 500,000 square foot in 18 years in the UK. One of them stayed vacant for almost 3 years before it was finally let. Panattoni, I think, have put up, in the last 2 years, stand to be corrected, but they've put up, if they haven't put up 10, they've put up close to 10 speculatively. There's not one let. They let most of them before PC. And that is where the world is really, really changing.
So I suppose my question is then, the life cycle of infill logistics is going to be considerably longer than big box or generic type. Do you not think that that's a direction you should be pivoting towards?
Yeah, I believe that that the ability also to, because land is so scarce, and very similar to South Africa, it's all fine and well having a 10-acre site where you can build a 200,000 square foot or a 300,000 square foot. But go and try and find a site where you can go and put down, a 1 million square foot warehouse. There's very few in the UK. And as you come south, really very, very few. So the consequence of that is that if you've got land in the right area, and we believe we're going to have a lot of really good land in the right areas, the ability to deliver across all fronts is, I don't see anything coming off in the short term. And the beauty of it as well is that a lot of the guys are signing leases now which are not necessarily just OMV linked. A lot of them are CPI or RPI linked with caps and collars, which basically almost guarantees you a kicker every 5 years. And obviously the UK system, 15-year leases are not uncommon, and 20-year leases are still there. So we're trying to play in that space to try and create that longevity of tenure and just give that steady eddy income stream. And if we need to own a 550 or 600,000 square foot unit let to DHL on a 15-year term, we'd be very happy to own that. We are very comfortable with owning that. But likewise, if we have to own a 150,000 square foot last mile facility let to an Amazon or a DPD or a Hermes, we're equally comfortable in owning that too. So yeah, we don't feel we need to focus on one area more than the other. Right? We feel that we've got land parcels that can cater to all of the above, and ultimately, we continue to promote our business on a very defensive strategy. We're an income play. Very differently to the UK funds. They give income, but NAV is probably even more important there than income. We're trying to promote that philosophy here, obviously with mixed reviews. There's some people that are very keen for us to drive the NAV story, and others that are less interested, should we say. We feel that if you don't drive the NAV story, at some stage that decoupling of NAV and distribution will be a problem for your business. And we believe that the NAV story, DPS is a function ultimately. NAV is ultimately what your business should be about. And I think that's what we've come to realize in recent years. And ultimately, if we can add, 10 to 15% of NAV to our balance sheet on an annual basis for the next few years, even if distribution growth is muted, as a consequence, obviously, of the UK and the 5-year uplifts, we still think we've got a great business. And as shareholders, that NAV uplift will result in a premium rating. And, having 20% off a NAV of 25 takes you much further than maybe a double-digit distribution growth, which is ultimately unsustainable. NAV growth is sustainable. I hope that answers that. Any more questions? Last one for the road? No. Okay. Well, guys, thank you so much for taking off your pajamas and coming today. I really appreciate that you've attended, and it's great to see you again, and hope to see you all again in May with the year-end results. And as you can see, we have recorded this, and we will be putting the recording on our webpage. So if you do want to watch it or watch parts of it, or want to cut out something or whatever, please feel free to look it up. And as ever, obviously, we're going to stay behind for a cup of coffee, and there's some food there. Please stay behind. If there's any sort of specific questions that you want to ask any of the team, we've got Akua with us as well, who heads up our Joburg team on the operational side. So also feel free to ask her any questions. And obviously, I think most of you will know Wynand from his sell-side history. And obviously, he's very close to the numbers and can potentially unpack a few details for you too. But and obviously, Ria and myself and Leila are also here for any questions. But again, thank you so much, and yeah, hopefully, 2022 brings back a little bit more normality and a bit of joy to us all. And yeah, I look forward to seeing your smiles more regularly. Thank you.